All right, let's go ahead and put on our financial analyst hats today. Welcome to this explainer, where we're going to impartially decode the incredibly complex and honestly pretty controversial regulatory mechanics behind the recent June 2026 SpaceX IPO. We're going to look strictly at the data, the regulations, and the market mechanics to figure out exactly what's going on beneath the surface of all those flashy headlines. And to really grasp this event, just looking at today's numbers isn't quite enough. As analysts, we also have to look back at the ghosts of tech IPOs past to see if history is, once again, repeating itself.
To kick off our analysis, we need to look at a staggering number that really sets the stage for everything we're about to cover. That number is $1.3 trillion. Just to put that into perspective for you, this is a valuation gap that is literally larger than the entire annual gross domestic product of Canada. When we as analysts spot a discrepancy this massive, it demands an immediate investigation. Because numbers this huge, they don't just happen by accident in the financial markets. They happen by design. So the big question we have to ask ourselves is, what exactly is engineering this trillion-dollar gap? This chart visually illustrates that exact gap, and it is a stark reality check. On one hand, you have this staggering $2.1 trillion market price established at the June 12th IPO, but fundamentally, if you look at Morningstar's rigorous discounted cash flow models, which are designed specifically to look past the hype and evaluate the actual hard cash entering and exiting a business, they pinpoint the fair value at just $780 billion. That is a massive chasm between price and actual value. So why on earth is the market flat out ignoring the fundamental math? Well, that's the exact anomaly we're going to unravel today.
So, here is the roadmap for today's explainer. We're going to look at the valuation gap, the index fund buying machine, the NASDAQ fast-track multiplier, the early insider exit, and finally, lessons from past IPOs. Let's get right to it.
Section 1. The valuation gap, where we compare active versus passive funds.
To really understand this gap, we first have to look at how the professionals are behaving. Active institutional investors, the hedge funds and portfolio managers who manually pick stocks for a living, they use rigorous spreadsheets and cash flow models, much like the Morningstar data we just looked at. These active managers are paid top dollar to find fundamental value in the market. And right now, our sources show these professional buyers are basically sitting on their hands. They are actively avoiding the stock because when they look at SpaceX at this price point, the math simply doesn't compute. Their models are screaming that it's fundamentally overvalued at $2.1 trillion. But wait, if the active professionals aren't buying, what is keeping the price propped up at $161 a share?
Well, if the pros aren't buying, who is? That brings us to Section 2, the index fund buying machine and its robotic shopping list.
Let's break this down using some simple logic. I want you to think of passive index funds like a robotic shopping list. When a stock gets added to a major index like the NASDAQ 100, these passive funds don't have human portfolio managers checking Morningstar valuations. They don't pause to say, hey, is this price tag too high? They are literally just algorithms legally forced to blindly purchase the stock to mirror the index. Now, historically, a company has to wait 3 months after an IPO to be included in an index, which naturally gives the market time to figure out its true value. But NASDAQ actually changed this rule recently, and the result here is totally unprecedented. They fast-tracked SpaceX into the NASDAQ 100 in just 15 trading days. Because of this sudden inclusion, passive funds were legally mandated to execute automatic buying of an estimated $3 billion to $4 billion in shares right out of the gate.
But it doesn't stop there. The squeeze is being intentionally amplified. That brings us to Section 3, the NASDAQ fast-track multiplier.
To make matters even more intense, there's another hidden regulatory gear causing this artificial demand, known as the float multiplier rule. Let me explain how this works. Only a small percentage of SpaceX's shares are actually available for the public to trade. That's what we call the free float. But NASDAQ's new multiplier rule treats that small float as 3 times larger than it actually is for index weighting purposes. As a financial analyst, seeing this is absolutely staggering because this isn't normal market dynamics. It's an artificial lever. It's kind of like stretching a rubber band to create artificial tension. If SpaceX has a 5% float, the index weights it as if it were 15%, forcing algorithms to buy shares that barely even exist in the public pool.
So the crucial takeaway here is this. There is roughly $650 billion in passive funds that track the NASDAQ 100. By artificially inflating the weight of SpaceX in the index through that multiplier, Nasdaq is forcing these funds to buy significantly more shares than the natural supply actually dictates. This creates a massive wave of manufactured demand that effectively squeezes the stock price straight up. It's a temporary, legally mandated hype spike happening before any actual active market value discovery can take place. So, what happens when this juiced-up price inevitably peaks? That leads us to Section 4, the early insider exit, and timing the drop.
Let's walk through this timeline together, like financial detectives, because our sources describe this specific structural design as essentially a regulatory bomb. First, on June 12th, the IPO launches at that massive $2.1 trillion valuation. Then, early July hits, and that fast-tracked, multiplied robotic index buying kicks in, forcing passive funds to juice the price. Then, late August arrives. Right after the price is pumped up by automatic buying, a custom insider lockup expires, allowing early backers and employees to dump 20% of their holdings. It is a calculated sequence of hype, an artificial pump, and a heavily engineered insider dump.
As financial analysts, we expect a standard IPO lockup to last about 180 days, so roughly 6 months. This standard rule exists for a very good reason. It prevents insiders from completely flooding the market with supply and crashing the stock right after the IPO. Under normal rules, SpaceX insiders wouldn't be able to sell a single share until December. But instead, they negotiated a custom accelerated release. They are allowed to dump 20% of their shares in late August, just weeks after their first public earnings report.
So, why does all of this matter to you? Because we have to ask who is on the other side of those trades. Remember earlier, institutional active funds, the folks running the cash flow models, view the stock as fundamentally overvalued. They aren't buying. So when insiders start unloading their shares at these artificially inflated prices, who absorbs that massive flood of supply? It's the everyday retail investors holding 401ks and IRAs, which are heavily invested in those exact same passive index funds. The structural mechanics dictate a quiet tragedy here. Everyday retail investors are perfectly positioned to be the exit liquidity for wealthy insiders. Which brings us to our final point. As analysts, we must look at historical precedent to understand the true systemic risk at play. Section 5. Lessons from past IPOs and how history rhymes.
The data on past tech mega IPOs like Facebook and Uber shows a very clear, repeating pattern. Both of those companies experienced massive initial public hype followed by absolutely brutal lockup expirations. When that new supply hit the market, with a simultaneous lack of active institutional buying to absorb it, supply simply overwhelmed demand and sharp price declines inevitably followed. But contrast that with SpaceX. SpaceX's situation is arguably even more precarious because the initial demand wasn't just public hype, it was structurally engineered by index rules. The sources warn that if retail demand cannot bridge that massive $1.3 trillion valuation gap when insiders flee in August, we could see a severe market correction echoing the darkest days of those previous historical examples.
As we wrap up this explainer, I really want you to deeply consider this structural reality. The mechanics of the market, from fast-tracked robotic index buying to custom accelerated insider selling, are remarkably complex and, quite frankly, often intentionally obscure. If active funds won't buy and insiders are actively selling, who exactly is left holding the bag? Please remember to always do your own research and consult with your own financial advisors before making any investment decision. Thank you so much for your time today and for joining me on this deep dive.